Hello. Just hopped over from the other call. Can you guys hear me? Oh, most getting coffee. Okay. Okay.
Hello.
He's grabbing another coffee.
Okay.
Something there, right? At least
What's
for
that?
me. I mean, the CPI kind of got people excited or like alarmed.
Yeah.
Um, but for me, yeah, I mean, Lucid Tesla, fun day. I just keep like refreshing Twitter like every 10 times. Sorry, every 10 minutes to see any more comments on this.
What's your verdict? Is that they just weren't ready?
Um, it's actually I like it, honestly. I like it they do it this way. Um, like I said in the chat, um, when I think a week ago I mentioned that the latest rollout of FSD has gotten a mixed review. So, if you want to get the robotaxi out, in August, then every single FSD update literally have to be perfect. It's gotta have those uh, big step forward towards let's call it L4. Okay, so L4 autonomous driving. But then instead of having a big stride on every single update, the latest one is kind of like a step back, where they are trying to minimize intervention but then causing the system to confuse and to be overly decisive and in an almost like a dangerous way, on its normal routine. So, I mean, it's inevitable. You have to get the FSD or like the autonomous driving to be more decisive, and you don't want intervention, because when you don't have a guy sitting behind the wheel, then you have zero intervention opportunities. So that I can see the direction they're pushing it, but the result is not as good as I expected. I mean, I have been trimming short position on this way up, because honestly, I don't believe that they will, have some kind. I mean, I, I I believe they will have something, but the reaction will be mixed. Right? I'm a little bit more concerned about the reaction. Like if they do have something at the event, the Robotaxi, August 8th, then how will it be perceived? Uh, you got tons of bulls out there. Adam Jonas, oh my God, I know the Goldman people, they are flipping side now and saying, we don't care about the auto business. We care about robotaxi, we care about AI, Dojo, Optimus, all of those things are value add, even the energy and solar business. We don't care about auto. Okay, so now you got a narrative shift when people are paying attention to those. And well, what's the result? If you'll get a big pullback if the result or like the underlying theme is kind of being denied. And that's exactly what happened today. I was adding short when the news came out, because I do feel the rally has been overextended, but it's painful to hold on to that short for longer. Um, before the event is released and go into earnings. I don't want to. It's I don't think I have like a super correct insight into it. It can go either way. It can melt down, it can melt up. But today is like a de-risking event, and I spent a whole day, trying to build on my model, and I haven't finished it, but I'm still working on it. And to see whether it's trading in a better range. I certainly like where the multiples pulling back uh, to a more reasonable level. But you know, there is a floor down there, which is the peak. I wouldn't call it like the peak optimism, but it's like the optimism before everything fall apart in Q1. So that level is about where we are right now. We're still like 0.1 times multiple above it. So right now we're at 6.9. Before it's like 6.8, and lowest we went down to 3.9 times. Forward 12, next 12-month multiple, and it's pulling back. It still has a little bit of room to go, but then after that, I think we need to probably position for a better outcome at October, because the reason for the delay is they want to get more test run in. They want to. Oh, this is all like Bloomberg. This is not. I don't think it's been confirmed by Tesla, or like on Twitter yet. So they want to have more test running. They want to do more they want to have the prototypes ready and so on. And in my view, it just makes sense. You don't want to release something that's bad, right? Baidu having the Apollo Go running in China, Bugatti and Rimac, right? Bugatti Rimac have their vision or prototype already out in Europe. So Tesla's no longer the leader in this field. Not to mention like Waymo and Cruise are way ahead, right? They already got a system running on the road. But like if they want to do it, they want to do it right. So I think it is it is even better this way. This is like a de-risking for my thesis of robotaxi not being ready. Yeah, so we'll see.
Hey guys, can you hear me?
Oh, hi Mo.
Hey.
Hey.
Yeah.
You make me want to get another coffee. I didn't got a chance. Yeah. Sorry, that was a little bit rant about Tesla today. Pretty interesting. Mm.
Yeah,
You know,
it's
yeah.
Lucid was up quite a bit.
Right. Yeah. So I mean, I might as well just do my bit first, and then we can move on to CPI, which is the main event of the day. So I probably won't have that much take away too much time. So yeah, Luce is interesting. Because in the early morning today, Peter Rawlinson, who's at the Goodwood, racing festival, Goodwood Festival, one of the biggest motor kind of. It's like a show. You also have like a classical run. In UK, it's a pretty good spectacle. So he's having an interview with Bloomberg, and it's all basically all the things that we already know. First of all, they need cash. PRF is a great partner. And people showing interest to do a tech deal. And Gravity production is startup production is we're getting there. It's good progress. It's all the things that we already know. But since the last time he talked, obviously we got Rivian with the Volkswagen joint venture, and we got basically across the EV sector people beating the Q2 targets. So it's kind of like more like a catch up move with the rest of the sector. Now we see Lucid's trading, close to EV sales, like close to the 3-month high. And it really closed down the gap. And it's trading almost at the the multiples where I think we need to be a little bit more cautious if nothing changes underneath. So yeah, I think it's also probably something to do with the short interest that high. I mean, we discussed it before. So but on the option side, I think there are some diagonal puts being put on put spreads. That's just from Bloomberg's automatic alert. So I mean, like, all of these companies except Tesla are approaching that upper ceiling of the valuation, and you really need something big to move the multiples up another notch, and you cannot have the ASP as a headwind too much into the earnings. So for Rivian, at least, good day. I trim my position a little bit in preparation for the earning, and I think the ASP is certainly something that not enough people are talking about. Some smart sell side already clinged on to that topic. So we'll see what the revenue number will be like. On Lucid, I think, yeah, it's a similar story now. So want to be cautious on the multiple side. And with a rally like this, it happened last time with Rivian, but then, last time with Rivian, 2 days later, you got the Volkswagen deal. So I'm not discounting that possibility. So, I'll still keep the position on. For Tesla, I'll just reiterate what I said before. Adding a little bit short when the news is released, but eventually, I think it's a good move. So the short is basically a tactical short in the short run. And while we are going back to the multiple that's more reasonable, then I'll take profit on the short and position for the earnings. Because if the event is moved back to October, then we don't have that catalyst in August, so we have more time to adjust and see what's up. And I actually like it that way. They move it down to October because it's more likely, it gives them more time to sort things out, make sure the prototype is really good. Than launching something that's like mediocre in August. I think eventually it's going to be good for them. But I also have a watch list of the people of companies that has robo taxis. So I put like Google, Tesla, GM, Hyundai, and Baidu in a little bucket today. So yeah, I mean, Google kind of sold off a little bit. I think that's probably down to the macro we'll discuss in a minute. Tesla down because of IDEO, but you see GM, Hyundai, and Baidu are still going pretty strong today. And I don't know about Hyundai and GM, but Baidu, that's entirely because of the Apollo Go robotaxi that's pretty trendy in China right now. And yeah, that sector didn't take too much hit, and um, I I think it's so far today after the consolidate, it's moving in the right direction, and we'll just see what happens tomorrow and next week.
Right. Sounds like a great update, Andy. I really liked your note, and I thought that your discussion about how you're tactically viewing Tesla was solid, and then also I think you've been talking about this like Hyundai deal for Lucid for some time, and it's interesting to see that it's like speculation is probably picking up.
Right. That's right. And because I think if people are buying quite a lot, even though it's per spread, and I assume there might be some dealer hedging at the back of this, because the call option volume also kind of doubled, and put spread also doubled. So there are some, I think, dealer hedging on the back of the move.
Do you
So-
know what the long strike is though? Because then you'll know if it's like a bullish put spread or a bearish put spread.
Let me check. For the put spread, it's like 250 and 350. That's where the most interests are from. 350 is like where people are opening interest.
One thing that I think is interesting is that today versus a week ago, vol has compressed. Vol has come down. Implied vol has come down for Lucid. So, but just from like a week ago, I'm looking at the
It could be because
Yeah.
it could be because we got the Q2 number
right.
in the beginning of like Monday. Yeah. So yeah, because they're like a week later than everyone else. I don't know why, but that's just the market structure, I guess.
Right. So that was like the traded event kind of a thing, and then but volume, stock volume was really high. So I think this is like indicative of like positioning. But the thing that I would say is that when you think that a regime is flipping, then you're seeing like a sequence of like positive surprises. Like that's kind of like what you think is happening, right? So it's like if we're seeing that there's going to be some normalization for like EV spend, if that is becoming more of the thesis that like EV will win share versus ICE this year, the EV dynamic and backdrop is getting better, then I think that you will see spikes in this direction. In between the spikes, you get the mean reversion, right? But the spikes are actually moving in a more positive dynamic, which I think is pretty interesting.
Exactly. So I do have one data to share. I need to like test this data with my own database. I haven't like built out my database yet with all of the EV and ICE sales breakdown and product mix breakdown. But one data I saw today was ex Tesla EV sales is up 72%. I think year over year in Q2.
Nice.
So it's like we do see this re-picking up of EV, and but the hybrid theme is still going on because people will look at Q2 data. People will look at like Mercedes data I showed today. Yes, hybrid is up quite a lot more than EV. But if you look at the industry as a whole, there are companies that just don't make hybrids. So you got to take that component in, right? They're kind of skewing the data in a different way. So yeah, I mean, the hybrid theme is still alive for people who believe them, but I'm in the camp. It's more like it's just a blip. People are gonna shift. We have huge replacing cycle or like model year update coming up in September, October. Stellantis certainly is doing it. All the other ones will follow, and yeah, we'll see. And maybe these company will make mistake and have too many inventory with hybrid, and that'll have a drag on the balance sheet.
Right.
Yeah. So yeah. But the data you show me with the CPI. Oh, sorry, it's not CPI. The jobless data. It's certainly interesting.
Yeah, we'll see how that plays out. But I think that's going to be, autos are becoming more of an important macro factor. I think
Right.
for the time being.
Mm-hmm. Exactly. So yeah, very exciting times.
Yep.
I do want to hear about the macro though. Like, what's up on the bigger side?
Yeah, Feng, you want to kick off on that side?
I mean, earlier I was like just reviewing like the CPI release. I mean, of course, like we got the first negative month-over-month print this month. But then like, I mean, there's like multiple like news hitting. So I'm just like looking at the subcategories. And of course, like the most important is shelter inflation. And this is like one of the most like the stickiest like inflation category for like the first half of the year, and today we finally see some like cooling in the shelter inflation. I think like the month before we have like 0.4% increase month over month. But I mean today like we got like 0.26. I mean it's like all around like a 0.2% like range. So I mean that kind of like uh gives like more confidence that like the disinflation path is kind of like there's like no roadblock on the disinflation path anymore. Also like the airfare is like -5%. So like the airfare for like the airline ticket price is kind of like down, and I also see like the used car prices down as well. So yeah, like a lot of like categories that were like deemed as like sticky are like all slowing down right now. So yeah, I mean this kind of like signals like the like perhaps like the rate cut is like should be coming like really soon. I kind of like miss the
Sorry, what was that?
sorry, like my mic kind of like my headphone went off power. It's like a wireless one. But anyway, like let's continue. But I mean just like the inflation is kind of like yeah, I don't think like the risk on the inflation side is kind of like uh I think Fed should have I mean, like Fed should like have enough like good data to kind of like commit to like a rate cut now. I don't see like there's like any like hindrance towards like this decision. So I mean, if the labor market side can also like confirm this, I think we will be getting like a move really soon. But like the next labor data, the major labor data is like after the July meeting, so probably like July is still like a very like dovish job only, but there's like probably like no move, and
Right.
we may have like a really big move on September, judging by like the trend of the data. Uh, yeah, I mean then there's like a I think right around the like the CPI release, I think the Japanese TV Asahi like they have like they claim that they have like government sources which confirm that there's like an intervention going on. So like I think earlier in this morning, like the yen went down like -2%. Right now it's trading at like 159. Yeah, I mean previously it's like 161 or something. So I mean, yeah, so like yen like the BOJ, MOF, like they're also like taking advantage of like the dollar weakness and kind of like try to intervene a little bit. But I mean, this is kind of like we only have this one source, so like nothing's like confirmed. We'll know this by the end of the month. So yeah, but I think there's like a huge move like in yen today. Um, so like some of like my previous trade ideas, I think the silver one kind of like worked. I mean, it's kind of like moving into the different like the right direction. I think silver today, the September expiry went from like 94.85, 86 to like 94.94. So that's like 8 bips. I mean, in terms of like rate, that's like 8 bips lower. Like I mean, like the silver futures like 8 bips higher. So and also like later we had the 30-year auction, which was like kind of bad. 2.30 bid to cover ratio and like 18 bips tail compared to like the one issue yield. I mean, I was like, well, I was watching the reaction of the futures markets, and it seems like the initial reaction was a down move, but like it got bought up like really quick. So I think the market kind of like shrug off the relatively like bad auction result and just like kept buying. Uh, yeah, so like where did the let me see. Yeah, so like the 10 years trading like 4.2 right now, like 30 years like 4.42. I mean, yeah, I mean, yeah, we'll just see like apart from these, I don't think there's that. I mean, there's like also like the initial jobless claims, but I mean like, that's kind of like it covered the week that is like over the July 4th weekend. I mean, that's the long weekend, so there's like a distortion in like seasonality, and that number is kind of like lower, but I think with proper like seasonal adjustment, it should be higher. I think like Shepperson has the statewide uh like granular data to like show like the labor weakness still there. And I think we can probably like get like another confirmation next week when there's like no like holidays or like seasonality interference. But yeah, overall it's just like pointing to like a lower rate. And we'll just see like how will like Fed actually like act in September. I mean, it's probably like now it's not about like whether they will cut, but it's like whether it's like 25 or 50, I guess, or even like more. If like the another like CPI negative print month over month, or like another like weakness in the NFP data, like a headline, if like headline actually like aligns with the other like labor market indicators, that like the labor market is like really cooling down. So yeah, we'll see.
Yeah, I think it's a really good point. I think from like a narrative standpoint, it's important is that you know the market was pricing in and kind of crowding in a very bullish scenario for for the equity or for, let's say, the economy. So like the best outcome would have been a continuation of soft landing where like the data is not getting worse, it's not getting hotter, but it's also not like falling. And so I'm I've been like kind of banging the wall, banging the drums that there's some correction risk. I don't think this is really like that though. Like I think I think this is more a reflection of just like slightly more aggressive positioning, like very short term. I wouldn't be surprised to see a little bit of a bounce back tomorrow, but ultimately probably for the market to close like below the open, and the reason why is because it's a shift in like positioning, like marginal flows. I think we're just in a backdrop where you're not going to get a lot of flow support because people are already positioned now in equities. And so if the incremental data is like negative, then it means that people will be, or like investors will be more cautious about allocating as much to equities as they were in say like the past couple of months. So in this dynamic, I think what we get is a shift in allocation. If the allocation shifts, then it means that there's now a new structurally weaker demand environment for equity, like that the backdrop has flipped. Now that doesn't mean that you get a big contraction. It just means that like on the margin, it's softer, and so you can have a day like today where equities are down 1%, tech is down 2%. You get that. You can get that a little reaction, given that environment. But what I would say is the most important thing is that macro regime is now flipping, and that means structurally that like flow is now less than it was previously in the prior regime. The hard data was still coming in like relatively okay or in line. Now, if we get the hard data surprising, I mean, I already showed you guys a chart of the surprise index over the past like month and a half. It's crazy low. Now it's going to move even further down, right? And so this is now going to tamp or like present a headwind to the macro, bullishness, that's priced in the markets. So on the margin, we are now structurally shifting. That's like one thing, and then two. I think the guidance is going to come in really soft. I mean, we saw that with Delta today, right? Forget about jet fuel. Yeah, that has been having an important dynamic over the past two prints, but looks like demand is going to be weaker, right? Fewer flights. He said he couldn't fill up his planes. There's too much capacity for all these airplanes, out there. So that's going to be another big headwind because what that means is that the consumer's not spending as much, right?
Right.
So this is that like now we're gonna get these so economic revisions, they need to move lower, right? Like they just started to move low, right? Or they were at 2.4, they just started to move to 2.3. Now we should start to see that continue, right? But on the earnings front, we saw like we were starting to see that the 4-week change in estimate revisions started to dip negative. I think that's going to start to accelerate because those two are going to be co-integrated, right? Like softer macro outlook, you're going to get that shift. And I think that the market here is, I don't know, this is where it gets a little tricky. And I kind of keep my views separate. So on the metric front, we're moving lower for sure because the estimates are going to move lower, and estimates are moving lower because the data is going to move in lower. Like that's what it is. If people forecasted growth, assuming a greater, assuming a higher growth regime, you just get a higher number, and now you got to reprice it. It's going to be a lower number, right? So the metric is going to come in. So then the question is, at the same price, that's a multiple moving higher. And can the multiple move that much with how the Fed is currently positioned? this is where this is where it gets risky because I said that there was a chance for that July cut.
Yeah.
And Powell's comments the other day like hinted that. So the big thing about what Powell was saying, like to my mind, is there's been this argument about how much time the Fed needs to wait before they can actually like agree to make a shift. And the Fed made this stupid decision last Sep that they started to use the 3-month average, right? And so now what that tells us is that they're going to want to look for like another print, which means nothing in July. Guidance in July, because they still need one more month print. Guidance in July, I don't think that it's going to end up being that dovish because they still need that 1 month print. And so, that tells you that what Powell is going to say is like, yeah, we're ready for a cut. We're probably, on track. If the data is the same, we're on track for a first cut in September. That's 2 months from July. And so, you're going to get more economic data between, then and, between July and the FOMC. So that in that environment, you're going to get jobs data. If I think we're seeing that, the risk on from the auto states, right? If that jobs data continues to come in softer, we get unemployment rate going up to like 4.2, 4.3. It could get, if you get the layoffs, then you could get to 4.5 easily by the end of summer. That puts the Fed in a very challenging place. I think that they have it's funny because on Bloomberg, like when I read, in like the chat rooms, like everyone is like, the Fed is inclined to cut. I actually don't think so. I have analyzed like Powell's comments, the past like decade, and like I've been following him since he became, the chairman. And I remember that even back in 2012, he had a very negative view of the role of quantitative easing and wanted to like speed up. Like he is biased against quantitative easing. Like he's biased against this concept of like Fed balance sheet also a very, very important role in providing liquidity in the collateral market. And so I think that like one of the big takeaways that I got in his testimony was that he is saying he sees that the pace of the Fed's balance sheet is going to persist, right? So that means that there's no change to the quantitative tightening story. So you have this dynamic where like liquidity is leaving the U.S. market. You're going to get, the dollar shortage story. I think it's not that bad right now, but you're going to get a squeeze to liquidity because you're going to have a dynamic where everyone right now is margin, or you look at a positioning, it's so extreme right now. And so if that liquidity dynamic continues to persist, that is going to put a lot of whoever is long, it's going to put them in a situation where like they're going to have to cut exposure to shore up their like margin position. So because in a low liquidity environment, they won't get filled, so price will move more extreme. So I think that is also like a risky setup. But I think that it's tactical. Like my view is literally for between the next 4 and 6 weeks. But I do also think that like equities will end the year around 5,400. So the fact that the S&P is, decently above that means I'm a little, I think that the market is it's going to move a little lower. But I think that a lot of that move is going to happen tactically over the next 4 to 6 weeks because of these dynamics. Like we're going to get like data that's going to accelerate to the worst. Economic data that's going to accelerate to the worst side. We have a situation where like liquidity, it's been communicated to like still be the emphasis is still tight on liquidity. We're going to also have a Fed kind of in a box where like they need to wait another month before they can really make a claim about the change to inflation. I'm kind of understanding now that set move that they're laying the foundation and framework, but the problem is that like now if the Fed goes back, then they're just going to go back to like a 3 cut versus a 2 cut, versus the 1 cut. So it's like I don't know. It's they have really put themselves in a box. They've not given themselves the room to raise that cut number. And because they're not going to raise that cut number, and they can't also, like, intra-quarter, they're not going to guide for like a materially higher cut level. If they don't guide for a materially higher cut level, then I think you're going to get a continuation of like a sell-off on the macro front, because that's going to happen at the same time. Like, think about that July meeting. So we have earnings season that starts at the end of next week. It's really going to pick up in the last week of July. And then we're going to have, the first couple of weeks of August, where you're going to get a lot of this, data. And the data is not going to look, really great. The guidance is going to come soft. So in this environment, you're going to get just like a bunch of think about like the news flow. They're all going to skew like heavily like negative. And right now the market is so positioned for like a inline or positive skew, right? Or positive, surprise slope. So that's the repositioning risk that, I'm really pointing to. So today is important because it's a chink in the thesis. It's a tracking the thesis. I think we're just starting though that process. So, but I think we're still early. Like, I don't really expect this to really pick up until the last week of July, once earnings season really begins.
Right. Just to add on that employment side, outside of auto, I got like quite a lot of friends in the media or like publishing kind of business, and what they told me is after, especially last time when we have the Hollywood strike from writers and like these like people in the media industry, like there's kind of like a distrust on like US workers in this field, and now because people like the hyperscaler already are putting up all these like AI tools, there has been a layoff round in those media companies. So you got like CBS, CNN, Paramount also cutting. So I wouldn't be surprised to see some weakness on the media and motion picture side of the NFP.
Yeah, that's a really good point. Actually, one of the things that I've been like reading into is that a lot of these studios, including like MGM and Pixar, have actually adopted a lot of these AI tools.
Yep.
So that's actually impacting their spend. So like they are for sure laying off a lot more workers because they're able to leverage AI for a lot of the things.
Yeah, exactly. So I think incrementally we are seeing the effect of AI, because last year when they're talking about AI, it's still not mature enough, but this year once the hyperscalers are ready, then it's really they're ready to go. So
yeah. Let's go ahead and shift gears. Barnaby, how's your update on Dynatrace? Or you're working on Datadog, right?
Hey, yeah, I was reading into Datadog today, and I want to just clarify a macro question because I think it's relevant. So, what explains the discrepancy between big and small caps today?
I think this has to do more with like rotation. So if you look at sector performance today, you'll see that like everyone was down everyone was up except for pretty much technology, communication, and consumer discretionary. And this is a classic like recession / early cycle trade. When you think that the Fed is going to cut interest rates, you pile into early cycle. Like that's what early cycle is. And so, yeah, you pile into small caps. So I think that's what we saw there. But the thing about it is, if the Fed was early to cut rates, then I think the trade makes sense. But because I think the Fed is actually a little late, it's behind the curve now. That means that the data across the economy is going to get worse. And so in that environment of the data getting worse, I think that small caps will actually disproportionately face the brunt of that. So I would be a little more cautious on the small cap front. However, that explains that performance differential.
Is that because Is that because dollar is expected to get weaker and the lower rates are gonna disproportionately?
If you watch like the Fed watch today, is like 2.5 cut already after the CPI. I mean, like usually like the small cap, like I think they are more like levered. I mean, they might need like more loans and like borrowing. I mean, like they're just like rate sensitive, you know? Like if the Fed watch is kind of like predicting like a 2.5 cut, I think market is kind of like adjusting to that expectation that rates like gonna lower. So like the small cap outperformance is kind of like a knee-jerk reaction to that. Like I think I agree with Mo. Like if the underlying picture of like the economy is kind of like starting to get weaker, then I think that's gonna like mean revert. Uh, if like more like bad data comes out, yeah.
Okay, nice. That does tie into Datadog versus Dynatrace, because Dynatrace has something like a 5x customer size average spend than Datadog, and they compete pretty much head to head. And so, yeah, I see that as I know it's indirect, but that would then the macro situation would be a point in favor of Dynatrace versus Datadog. Another thing to add about Datadog that I was unsure of yesterday was that this price consciousness of Datadog's customers has accelerated, and Datadog has actually brought out a product. It's called like cost optimization something, and they have put themselves in one of those applications that you can monitor the cost of on top of everything else. And so one of Datadog's partners said that customers who are surprised by the bill, they end up just moving that to a different part of Datadog. So they just expand within the products, but they don't actually reduce the budget.
Interesting.
But that, I don't know how strong that is, because surely, I mean, so at what rate then do you see the deterioration in the economy going to accelerate budget scrutiny?
That's a good question, and I think that the problem with looking at that is it doesn't really capture how these companies generate revenue, which is through the mix of billings growth and expansion. And so, you have companies that are like Microsoft. They're going to continue to spend money, right? And if they're developing AI tools, all the AI startups right now are going to continue to spend money. And so, if they're using Datadog to help them observe, their data sets and their code, they're going to continue to spend money on that, even if the economy like slows down a little. Like that's not going to change. That's not going to derail their thesis. Their spending plans are set, and that is why you get that like secular type of a trend that emerges. It's not because something is super crazy. It's just because the terms don't change in the period, right? Like if I have a 2-year contract, I'm just not going to break it for 2 years. And so like in the data, it's gonna show that I'm less sensitive to like monthly changes, right? That's a very important dynamic here, because if these companies are they're in a 2-year contract agreement, yeah, they're just going to continue to spend their contract commitments. So I don't think you should worry, or I don't think you should factor in too much about the macro into when you're analyzing Datadog or Dynatrace right now. I think the way that I would do this is you have a good understanding as to what's going on with Dynatrace, what's going on with Datadog, what's going on with these companies, and you understand the gradient of views and how those views roll up into estimates, and what consensus is implying around billings growth, net new logos versus expansion, and then you could compare that to what you think. And you might say, like, what do you think about guidance? Do you think that guidance is conservative? Where in guidance is there conservatism? Is it in the local growth, or is it in the expansion side? And then, okay, then what do you think your view would be? And you can look to see, like, well, on average, it's surprised by, say, 2% or something like that. So you could say, okay, well, then I think that would be like the baseline, and that would put my sales estimate at X amount. Currently, the market is pricing in, B, and what's the thesis around that? What are the different theses, and what are the levels of revenue or margins that corroborate with those? And that's how you like set up the trade. So sometimes it doesn't matter that you necessarily know all the answers, as long as you understand what other people are betting on. Then that is super useful. I would almost say that knowing why other people are betting the way that they are betting is probably more helpful to you, because you are speculating and you're trying to get between them and when they shift their expectations. Okay, like go back to like that estimate revision sort of a thing, which is like, what would then drive an estimate revision up or down? And then so we're getting into earnings season, so it's like you might say, hey, guidance is conservative. On average, guidance beat by 2%. So I'm assuming that, what does that mean about new logos and expansion? It means a net retention rate would be like, say, in the mid 110s, and their billings growth would remain really elevated at like maybe 20-30%. So that's the dynamic that you're like, this is like my base rate, my base case. Consensus, if they, that, you don't really have to analyze consensus here because you're starting off with that as your base rate. And then you could look at, okay, well, I'm looking at the range of views out here, and there seems to be like 4 different stories around the company. One story is that there is like, there's a market share expansion tailwind because they're actually competing and winning over the APM space. There's another thesis that actually they're becoming a consolidator, like observability is moving into a platform, it's platformizing, and this is like a key beneficiary of platformization, because like that's what they're pitching when they're trying to win customers. And then you have a third that's like, no, bearish on platforms, bearish on APMs, think that growth is going to come in soft because enterprise is just not spending. And then the fourth is, actually this AI tailwind is going to be pretty massive because so much money is being pumped into AI, right? So with those views laid out, you can then see, well, what does each view, what does it correspond to on a revenue and margin front? Okay, so now you have the scenarios out there, and then okay, well, your view is that like, okay, well, you're gonna guidance is conservative, so it's just going to be a little better. And you may feel that the other scenarios they're not strong enough, so you would just discount those views, but you price them to see what would the stock price be at all those different levels, and then you can look to see at where the stock currently is, and is the stock currently pricing in a view at like 80%, or is it like really pricing in a certain outcome that you're like, that outcome is just like, it's not that certain. Like we didn't get it. There wasn't any new information lately that would have supported that thesis. So you could disagree with it. That is the stronger way to develop, to know that you've got some kind of variant perception. But what you're doing right now is you're thinking about like, what is fundamentally happening with the stock, okay? And the story behind like what is actually happening with the stock, you would need more information. So you would need to talk to experts, or you would need to read more expert transcripts about like what they're saying about their usage or consumption or so on and so forth. So for sure, continue down that angle, because that's going to give you like a deeper insight. Like maybe everyone is wrong about something, right? But I recommend starting from that other level, which is look at your view, which is like, okay, well, guidance seems like it's conservative, and then obviously, why do you think guidance is conservative? Well, historically, they tend to beat by 2%. 2, they gave a guidance that was well below they normally get in this quarter. You might have and then also like the data that I'm looking at that corroborates like their say peers or competitors or end market users shows that demand is still pretty strong. So in this environment, I think that their guidance is a bit conservative, and so that's my initial disposition. You want to have that set up first, because then you can dig in deeper as you do, but that will help you like figure out your view. You'll just be more aligned as you go down the research path. The process that you're going through right now, it's a good process, but because it's not linked to like, you're not linking it to like the different scenarios, like clearly at least, like maybe you are, but like, so if you aren't though, then the problem is by you going deeper, it's not actually helping you understand in like your perspective versus everyone else. It only helps you to go deeper if you know what everyone's perspective already is, because then you know what everyone thinks is going to happen, and you can immediately say, hey, it's actually not going to happen. I dig deeper and find out that that's not happening. Does that make sense? And another thing too is if you see that there are two diametrically opposed views, say one is like, hey, data is improving, and someone else is like, data is declining, right? Then take the midpoint, because like you actually have to wait for the outcome, right, to actually know what's happening. So in between today and the day of earnings, if the stock prices in one outcome more than the other, like you're like, fade that. Don't carry your trade to earnings though. Like, but fade everything from now to earnings, like outside of that range that you think the stock should trade it, because then you're saying that, oh, then the market is disproportionately showing one view, or like taking one view, or pricing in one view, when in fact we're at, you can't, there's nothing incremental that would have changed that argument.
Okay, nice. Yeah, I still haven't gotten to that stage for either Datadog or Dynatrace, but I'll be doing that next. I saw an interesting. Sorry.
I feel like with Dynatrace though, like your scrub was really, really good. Why don't you feel that you're there with Dyna?
I think I probably am. I just need to write it down in the style of scenarios that you've described.
So I'm looking at your, you've got like, for example, what the thing that you want to add to your Dynatrace note is, so for each of the banks and their estimates, or like you've got like their price target and their valuation, put in that estimate for this year and next year. Okay, so you definitely want to include their revenue and EBITDA estimates, because that's the number. Like if for example, let's say like JP Morgan, they are like, oh, they're refining their GTM strategy, they're allocating more resources to large customers. This is all going to be good for the stock, and this therefore means, $1 billion in revenue next year, right? Like that's what you want. You want to know. Okay, well, what do all those critical factors boil up to on a metric, number? Like what is their estimate of that? And it's not, this is all ex ante, so you can't like empirically validate like that view from today. It's the future. You cannot empirically prove the future today, right? Or you can realize the future, but you can't empirically prove it today. So you can't empirically prove that that's going to happen tomorrow, right? So you have to create an argument. So they're making an estimation. They're like, well, okay, if I see a go-to-market strategy that's pretty good, the way that they're thinking is like, then if the company's growing at 15%, then they can go at 18%, right? Like that's how they're going to think through it, right? Or they're going to look at like their TAM. So in the long run, they should average a 15% growth rate. Like their CAGR should be 15%, and currently it's going at like 14%. So you're like, I see some upside for their growth rate. Their growth rate can actually rise to say 16%. That would help them balance out, get back on track to that 50% CAGR. So that's how that's how they're thinking about the how they're getting to that percentage growth number, and ultimately that revenue figure. Okay, and so you want to know that and be like, okay, like that's what you're kind of highlighting, and because no one can empirically prove the future, it's okay for you to assume that that's how the buy side is approaching it too. Like it's not. There's no one that's going in with like, oh, I have figured out the future and therefore I know exactly what the number. There's no one that has that information, right? So like, thank God that that's the case. And because no one has the future, what that tells you is you can you can take like the argument layout and corroborate it to the revenue figure, and that's what it is. Now just keep in mind that you can look at the surprise, like historical surprise, and that tells you how far off consensus on average is from the actual trend, right? And so like you want to incorporate that because no one can predict the future. Even the way that people are corroborating a revenue figure could be wrong. In fact, many times it's wrong. The people are right for the wrong reason and wrong for the right reason. So it's just like, which is super confusing. But it's like they may say, oh yeah, they're actually macro is really weak for Dynatrace, so their revenue is going to come in at like half of their growth rate. But actually, maybe macro is really bad for Dynatrace, but they grew actually faster because they were able to expand to existing customers. So that analyst would have been right about like what was actually happening in the market, but they were wrong on how that applied to Dynatrace. So you're going to see that a lot, many, many times. That's okay. That's part of the normal variance in the stock price. And so what you want to do is focus on the argument and then what that means on like a revenue figure. And again, you want to look at this and next year because sometimes the argument is actually over next year. Or if you know what the terminal number is, like Dynatrace says, 2027, we expect to get to 400 billion or 400 million in sales. Right? That would be the terminal number, right? The quote unquote fundamental bet. And then you want to then plot it that way because that will help you kind of create those links, and then you can analyze it. And then as you go deeper, like you may be able to uncover new information or think about something in a new way that might allow you to like change your entire perspective. But if you don't have that, the problem is by you going deeper, you're not going to be able to, you wouldn't know like what would be the trigger for that, if that makes sense. Like, you probably have been reading to the point where you're getting like really close to like 95, 96 percentile. But maybe because you don't have the revenue figures laid out, it's really, you're going to struggle to figure out what that growth rate would be, okay? Or like what the information that you're reading tracks to. And that's how you should, that's what you want to try to really do, which is like see what you're reading, like expert calls, you're reading additional like new information. What is any of the information tracking to the cards that are laid out on the table? There's no need for you to try to create your own card. Just think about like what are the different hands on the table, and what are they like saying. And obviously, the stock is not like no one is going to get it perfectly right. No one is going to nail it. Well, you'll sometimes see people nail it, but like most of the time they're not going to nail it. So the price is actually going to end up, and like revenue and the metrics are going to be somewhere in between, two different scenarios, and you just don't know what cluster of scenarios that they're going to be in between unless you like everything you read, you say, how does this fit relative to the different, scenarios that are outlined on the table? Does that make sense?
Yeah, that makes sense.
Yeah, I want to like hammer that in a little because it's one of those things that is going to just drive you nuts otherwise. I've been in your shoes, analyzing companies and feeling lost. And like the more that I knew a company, the more I didn't know what was going to happen. And that's the Dunning-Kruger thing, right? It's like you hit that, the value of despair, which actually tells you that you've learned a lot about a company. But the way to keep yourself sane is to constantly compare any new information that you've gotten, constantly compare it to the different scenarios. And that's where I really like the poker analogy, because obviously markets are not that simple. But if you think about the poker analogy, you limit what you're doing, because you have people's cards, like everyone has their own hand, right? Their cards. Then you have the flop, and then you have the pile. You got the bet, the pot. So there are just those three variables that you got to pay attention to, and then you, as the other player, can look to see, okay, well, this guy just raised, and this guy, matched, and this guy, he folded, and then the other guy, he raised. So it's like that is the information. The raising that happens, that's the stock price, the multiple expanding or contracting. Okay, and the raises and stuff, and the folding, that's all going to happen based upon like how incremental information comes in. That's how it should track, right? Like you get a new, another card is turned over on the flop, and you should expect a repositioning based upon that, right? Some of the people, there's only going to be one person at the end that is going to win, that pop. So there's like one person in there whose scenario is actually aligned to the outcome, but they don't know that's the outcome yet. They will only know at the end of that hand, at the end of that deal. So because of that, right, they're making estimation bets. They're lifting the multiple each time as they get incremental information that tracks to their thesis. Okay. And ideally they want to be at a point where like they're constantly just matching the probability. But sometimes they get overextended, right? They might, maybe they get into like a pissing match with someone else, right, in the game. And so they have to raise some dramatic amount. They have to go all in to kind of like push someone, right? That's positioning risk. That's super risky. We want to avoid that positioning. Like luckily in the markets, we don't have to do that. So we don't have to go all in, on a name. But that's the kind of positioning risk that means that you get a big distortion in the multiple because of that. That's how you should perceive it, and that's why you always want to fade it because scenarios are so imprecise in the market. It's like they're going to be specifically wrong. Like that's an easy bet to take. It's just the question. It's like what's the so limit what you do with this. Like do the readings, but track them through the thesis. Make sure that when you lay out the information, that is so valuable. Like that is like the way that you should see is that like that's your source of alpha. Because everyone, like all of these analysts on the street, they're reading third bridge, they're reading those call transcripts, they're reading the same sell side stuff, right? But what are you doing that they're not doing? Laying out, right? You have this process where you're laying out the gradient, and so you understand something better. That gives you a behavioral edge. It also gives you an analytical edge because you're able to make sure that you're focused on a variable, like a risk that you've isolated that you specifically want to take risk on. Like you might find that like of the bullish scenarios, they're all contingent upon like new AI spend. So now you know that's like a key like bet that like all the bulls are making. And maybe you're able to find out that like, oh, actually, so I was, digging into other things and well, there's a lot of competitors in that space. So it's unlikely that Datadog is going to like show real leadership. Like it's probably going to still grow at an okay level, but they're not going to show like amazing leadership for that in that category. And what that means is people are positioned so much for that outcome that, oh, this is a big risk to that thesis. So that's how you can kind of get those, like infer, what's happening there. Hopefully that was, helpful. But I just want to, help you with this because it's one of those things that for sure, will drive you nuts. And you'll pull out a lot of hair, and hopefully the hair grows back, but you don't want to take the risk, right? So better to, almost narrow what you are doing, so that way you can kind of quickly see, hey, is this something that's going to change? Is it going to track to any thesis? Is this unrelated to a thesis, or would this help develop a new thesis? But to get to that point, you have to know the different theses, right, for your company.
Yeah, great. So that's really the coverage process, right? Looking at all the incremental information since earnings.
Right, since last earnings, exactly. Yeah, I mean, so ideally, the coverage process is you're updating that every day, right? And like not every company has an update every day. So, there's most companies no real change. You might get it. You're gonna look every day to see, hey, has anything changed? But like, it's like you're checking your fishing nets every day, right? But most days you're just not gonna catch anything, and that's okay. Or you might catch like one fish, and whatever. So, but you just do this consistently, and that's how you kind of stay on like the narrative, and you understand like how the narrative might be shifting. And so what happens is you go check your net, right? that's like your daily discount. And then you also look at the multiples, like, hey, what's happening with the stocks? Are the multiples rising or falling? And then you want to see any new equity research, is that shifting, causing an estimate revision moving higher or lower? So that's the coverage process. And the reason why is because like I don't want to say that like I don't want to make this sound so simple, but the scenario should be obvious. Like there are very few companies that are like misunderstood. Most companies that are publicly traded nowadays, like they have enough companies that we're looking at, especially, they have enough analysts that they're pretty well understood. And so because of that, like there's no like really amazing insight that's hiding under the rock. So we can't like work harder and get more informed necessarily. And so the best thing is like what you do your initiation, and that's how you find out like what's up with the stock, right? Like that's pretty much most of what you need to know. And then you read sell side. So now you know all the different scenarios and the different theses on the street. So from that point, you did your initiation, so you can understand, okay, what is the company, like, what do they do, how do they make money, like, blah, 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 right? What is their software, who do they compete with, what kind of products do they have out there? And you say tracks like, what's their product roadmap, blah, 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 if they have that, right? The investor day stuff, so on and so forth. And then you read the sell side, okay, how did the sell side view them? What's their thesis? What's their scenarios? What's the critical factors? Okay. And then you start on the coverage process. So the alpha, like when you just do the initiation and the that first, the sell side, that's your ramp period. Okay. You build your model, so on and so forth. No one, when you ramp, you don't generate a trade idea. Like that's not gonna typically give you the opportunity to generate a trade idea. That's just like you set up something. You're now like you've installed the company into your hard drive. Okay. Then on a daily basis, right, you do your coverage, or say on a weekly basis, right, you go through the coverage workflow. So you're looking at, hey, any incremental information has shifted, whatever, right? So over time, as you go through the quarter, you're going to start to see that for some companies that a thesis begins to track. Some, like maybe you make no bet in the first round, right? But as you go through time, you can see who might be the winning scenario. Okay. And you would put your money kind of on that trade. That's kind of what it is. So it's really that over time that you really develop a view and opinion of a name, and you begin to see it like companies on a gradient, and sometimes they are more fair. Like you take advantage of like when there's a shift that's taking place across, your coverage, and this is why on the buy side, you're typically looking at between 50 to 150 names, maybe like 50 names like more in depth, and then like up to 150 names like secondary. But you're looking at that many names because like out of those names, maybe only like 5 to 10 are seeing any real big shift right now. So you might be pretty neutral on everyone else, but just in 5 to 10, you might have some actual view of what's happening. But that understanding is actually super valuable because if you feel like, hey, all these other stocks are more fairly valued, then you know that like ultimately what they're waiting for some like industry wide catalyst, like macro event, right? Interest rates fall, then you can get some interesting things to happen, or like a company is only fairly valued when it's fairly valued. If tomorrow the company moves out of range materially, then hey, something might be up, right? So then you can go and you like mine through to see what's happening. So it's really important to understand that it's like on this coverage of like a larger amount of stocks, you're going to have maybe less than 10% that are actually like going to be in play for the quarter, and the rest of the but that say 10%, the composition is shifting. Maybe only like 3 to 5 do you actually have like any longer term view, like that's multiple quarters long. But for most of the names that you're going to get in there, they're just there temporarily because there's some, they're traded off or something, and so you're pretty much trading like more tactically, in there. And that's really like the pod style, of investing. You then will have like 2 or 3 names out of 50, so maybe like 5% of the names that you're covering, that you're going to have a more longer term view. And that would be a case where it's like, maybe you have a view like, hey, for like Zscaler, and what would drive this is not actually your like view. It's not going to be like, oh, I really like this name, Zscaler is accelerating. It's that the market has just not effectively reflected or priced in the proper outcome. So a good example of this was like NVIDIA. Where like NVIDIA, like here's a problem with NVIDIA. The market is not pricing in like the TAM that NVIDIA has. So I like NVIDIA structurally, and until the market prices that, and it's the stock will have to trade at like 170, almost 200 to fully reflect that TAM. So I like the stock for multiple quarters. Well, it depends. If the stock trades at $200 tomorrow, then I'll be probably lean short, right? But if it trades, between 100 and 130, it's probably in the zone. I'll probably buy it, within that range or whatever. Now then I'll compare it in a like more tactical front, which is like, well, in the quarter it trades at like 15 times, sales, whatever. And so I'll keep it pinned to around that level and trade it only when it's like got value to that. But structurally, I'm going to like that name, and it's going to stay on my watch list as like a long, candidate. And I probably won't ever short it and there will be times where I'm like really long it, like max long, like 8%, and then there's going to be times where I'm like 1% long. Right now, I'm at a 1% long. I actually, last week dramatically cut, my, the size of these positions because they were trading up, too much. So, dramatically cut them. So now they're at 1. And then guess what? Stock is down today. If it goes down a little further, great. I'll probably increase my, as long as I'll update my note and say, hey, do I have any change in the view? No, change is actually still positive. Still have a positive, outlook on where the company is. Then now it's time to lift the weight. So that's how you're going to kind of trade names through the quarter. You're going to have a bucket of companies that you like structurally, and so you're going to want to be long biased on. You're going to have names that you're going to have like a short bias on, and then but then things, it's not that you can just like buy a stock and just hold it for like a year like that. Sadly, when you're a professional investor, you're just not going to think like that. There's no like, oh, I'm going to set it and forget it. Like every stock that you're going to put in your book, you're going to be like, I don't want to say micromanage, but you're like on it and watching it, pretty much, daily, so you're going to be constantly tracking and updating, the narrative of these names. So it's important for you to think about that multidimensionally, right? That what's happening with like that longer term target, like for example, with NVIDIA, it's all about the TAM, and it's like, if I feel that sell side estimates are catching up to the TAM, or like buy side is catching up to this TAM outlook, then I think that's, maybe then that's diminishing the future returns for the stock. But if I think that, that TAM gap is still super wide, then I'm going to still fundamentally like the name, and I'm just going to go from having a 1% weight to an 8% weight, depending on where we are, where we're trading. Okay, so that's how I want you to kind of think about this, which is like, you are always going to be a little active. You're always kind of adjusting your positions based upon what is being priced into the stock relative to the views that you have, both on a long-term basis and locally. And so for like the quarter, I almost want to say like it doesn't really matter if like Dynatrace or Datadog like beat in the quarter, like beats no longer matter. I know everyone's talking about beats and raises. Actually, nobody cares. It's not really about beats and raises. It's about guidance. Well, guidance lifts. So what is the estimate for like next fiscal quarter and like the NTM? And is that something that is at risk to the upside or downside, with the company's guidance? So that's kind of, you're going to want to like position to focus more on those lines when you think about your name and how that's going to work. And by the way, that's literally that's like how you would want to trade any asset. So whether you're trading, macro or you're trading equities, it boils down to the same thing, which is really need to understand like the forward guidance, because the beat, that's information, and the market should be pretty good at incorporating new information into the stock. Like people are not stupid, but people do struggle with expecting the outcomes of future events that we don't yet know about, right? So like guidance is where there's variance. Guidance either from the Fed or guidance, from management of a company. And so that's really where you want to spend your time focusing on. And so knowing what guidance, or knowing what the critical factors are in those scenarios, is going to help you understand like where is this going to put guidance at. What I'm talking about, this is like, it is a little different, but again, to do that, you have to be very comfortable with the thesis and scenario. So I want to say that to some degree, you can actually work a little less hard because you know what the dynamic is. It's like you just have to you did like what you did with Dynatrace might have taken you a couple of hours to go through the cell site to scrub it and to break it down, and then you built in these the scenarios, right? So that's that's like a 2-hour commitment, right? Or I don't however long it took you. If you focus on that, okay, just do that day after day for any new company that you're going to cover. Just replicate that process, and then on the daily basis, track information to see if it's hitting with the thesis or not. That's how you're actually going to position. And I would spend most of my time in that posture. Now again, you for sure can go down rabbit holes. That's exactly what you want to do. And I love the fact that I love hearing like how deep you go when you're researching these companies, because honestly, I get excited. I love it. I do the same thing. The thing that you want to make sure though is like, think about that. I forget who was it. Was it like Odysseus who goes into the maze, right? And you would get lost in the maze unless you put thread, right, or leave a string of thread to find your way back. Okay, so that string of thread to find your way back through the maze is these different scenarios. Always make sure that you're aligning, that you're tracking any incremental information or some that you're reading to the different theses. And what I recommend doing is when I read a note or like a transcript, I'm not really like writing notes on the transcript. I'll read through the transcript and I'll highlight a bunch of stuff. But then at the end, the thing that I do is I synthesize it. So I'm like, okay, what is this information track to the scenarios? And I would tell you that I think something that I know that I would say that I'm probably good at is whenever I read anything new, I kind of have the scenarios on my mind, like as I'm reading. So like as soon as I see something that like tracks, that connection lights up. And I don't know if it's just because I've done this for so long, but I know that is something that for sure helps me. It's what whenever I like pull up something, if it seems like I'm quick to find something, it's because like I'm thinking about those scenarios. But how do I think about those scenarios? I do that same thing. I break it down. I do exactly how what you did for Dynatrace. That's exactly what I do. So have that up as a cheat sheet and like really run through it right before you read, and that I'm sure will help, because you'll be like, oh, I see an echo of this in the JP Morgan note. Like that's something that they were talking about. But this came after their note. So that means that this should support that thesis. And that's how you can try to track it through.
Nice. Yeah, that's really helpful. I wonder if I need to get rid of the semi-bull, semi-bear scenario. Just have one that's for everything that's priced in by basically everyone, and then the good stuff and the bad stuff.
Wait, say that again. So you said you want to like simplify your scenarios.
So yeah, I mean, so the way I did it before, I know you've suggested having the scenario should be unique for each company. What do you think about having a base scenario, which is just everything that's priced in, and then another scenario which fits like the ideal, and then another scenario which fits worst case outcome, and then having all of the information that is not priced in but is a risk in one of those outside scenarios?
I think actually the way that you have it is good, because you want to, you want to know. You don't want to be like too ambiguous. So like, it's good for you to know like what the number actually is. Like, what is the number that people are paying attention to? That's key. And then you want to know like how the analyst, what is going to make them change their mind. So I almost think that like the best way to do it is like for every analyst that covers the name, you kind of make it the scenario around them. But I think it probably is a much better use of time to, you can aggregate like the bull scenario. Like if you see that like Needham and JP Morgan are pretty much saying the same thing, then they're both like, then that's just one scenario, right? There's no need to have two different scenarios for them. But sometimes you will see where it's like JP Morgan and Needham have the same bullish scenario. Barclays has a bullish scenario too, but it's different. They have different critical factors. So I would then make the Barclays thing different. That's important because you just do this up front, and I don't know how long it takes you, but like normally that's like a 2 to 4 hour commitment to get that part done. You have to understand that like when you do something like that, it's kind of like you have now like a pot of gold when you do that. Like the value of doing that is so high for the time that it takes you to do it. Like I don't think that there's not a lot of things that you can do for like 2 to 4 hours that gives you such valuable information. So that's like a low hanging fruit. Like you should always do that. And I think that the way that you did it pretty much is right. I like how you're highlighting like the critical factors and where the similarities are. Like I think I really like that setup. As you get better at this, you might have a couple of fewer line items. Like when I have like my scenarios, like I might just boil it down to like what I perceive as being like maybe the 5 key things, or 4 or 3 or whatever. Like so you're gonna get better at tidying up that stuff, but I don't think you should worry about that. That's just gonna come from practicing this, more times. But I would say stick with that because the current pricing is super easy to do. Okay, you just set it once in your Excel, or I even have it on both Excel and on Bloomberg, or like I can quickly just see the change in the multiple from the last implies this revenue figure, right? And then I could see, okay, well, what scenario is it tracking with? Oh, it's tracking with the best scenario that I've got. Okay, that means that there's limited upside to the stock. Has there been any like new incremental information? No, nothing would have changed it much higher. Okay, so it's trading within a range that I think is reasonable, but it's at the high range. So, but that's going to update in real time. So you don't need to do that replication for what's priced into the stock, because that's actually what you're going to look at every day. That's where you have the watch list, and then you compare it to what you have on your spreadsheets. Like that's that workflow, and that is, but that's the easier part of the job.
Nice, thanks. Yeah, that helps.
Does that answer like what you were getting at?
Yeah, I think so. Yeah, just need to. I'm still just a little slow at that, I think. So.
Well, what I kind of think that you should do, and actually, I'm happy to spend some time with you on this. Is maybe we go through like Dynatrace, because you have that laid out really well, and we just go and we could polish it up to the point where like you have the different scenarios. You pretty much have the different scenarios. You get to a price target for each of those scenarios, and then we could just quickly look to see, well, where's the current price at, and what is that telling us about what's been priced in or not? Because that ultimately, like that last part, which is where is the stock relative to what our scenarios are priced, like that is ultimately like the trigger for us on whether we should buy or sell. And so I think going full circle will be super beneficial, and we should do that, but we should dedicate some time, and we can do it in the morning, so it's easier for you and we're fresh.
Yeah, please, that would be great.
Yeah. Otherwise, though, like I'm very impressed with your notes. you are exactly getting, you're getting all the information. So, and it's really that reason. Like the fact that I'm seeing your notes are so good that I'm like, Army, you've got what you need to do this really, really well. The maybe the missing piece and the thing that might be frustrating you is just linking it to then the different scenarios and just getting used to like thinking in that way, like just tracking that information to a scenario. But we'll spend some time to go through that. Okay.
Great. Yeah. Thanks. Please. Yeah.
Cool. All right. Any other questions or discussion points?
I just want to mention one data point from Datadog's summit, where they said that 85% of the generative AI use cases they had seen had not made it into production.
That makes sense. That means that we're still in a proof of concept phase for AI.
Yes.
Cool. I mean, we're in that like period where everyone is like building the tools, and we'll see how it comes out. I'm kind of annoyed because like a part of me is like, I have so many use cases for AI. A part of me is like, should I just do an AI startup? Because like there's just a couple of things that like that are super applicable, and I'm like, why isn't this out yet? So,
I have a friend who's knows all about AI and is desperately looking for use cases. So
you should
definitely talk to
connect us then. Yeah, I'd be happy to do a call with him.
Yeah, great. I'll do it. Actually, introduced him to James. I'm not sure how that has gone.
Oh, nice. That's cool. Who was the guy from Manchester on the call earlier?
Yeah, that's my cousin's boyfriend.
Oh,
I
cool.
mentioned him
Okay.
before. Yeah.
Nice.
Yeah, he's like he's very curious, and I think he'll be good.
That's cool. Have you guys met up and like you guys chat about the markets a lot?
We've met twice. Um, when I found out that he was into trading with technicals, I kind of gave him some food, fish food, and yeah, he took the bait. So here we are.
Nice. Also, I wanted to ask you a quick question. So you did those you've written scripts for like trading, right?
Yes.
Does it have options data?
No, sadly.
Got it. And have you done any like scripting on other platforms before?
You mean equivalent scripting languages like TradeStation or something, or do you mean like Python?
Either.
So no, but I know that all of them are very similar. I could learn the other ones probably quite quickly. Um, they all basically have the same limitations though. And I've done a tiny bit of Python, and I find it kind of fun, but it's a big time commitment. That's all. I'm not very good.
Yeah. I have this massive spreadsheet. I've shown you guys before of like my the options on the S&P and how they're structured, and I would like to turn that into like a widget, like an app, and I was gonna try to do it on R because that's what I'm more familiar with and make a shiny app, but I don't know, kind of like hesitant just because it's been a while since I've made something like that. So yeah, if you guys have any suggestion on what type of script or language would be like best suited for that type of analysis, all ears.
So what are you trying to do exactly?
So I have a spreadsheet where I plug in a ticker and it gets a range of options data, mainly like open interest and option volumes. across a range of strikes. And I'll set like the expiry. So I set like reg expiries, and then it'll grab all the data for me, and then I plot it on a chart, and the chart shows me like where the clusters of open interest are through time. So it's not limited by, there's an app on Bloomberg called OPX where I can see like per expiry, like what the option structure is. But I want to see like what it looks like through time. Like I want to see like the next, say, 3 months worth of regular options, positioning looks like for, the S&P or, a stock that I'm interested in. But the spreadsheet is like super clunky. It's laggy. Also, it runs into some problems where like I have to set an interval for the strikes, and I'm like manually kind of grabbing the strikes. So it's not perfect. So I think this is a great use case for, because I don't need to change the spreadsheet that much. Like I know what the parameters are. It's it's definitely a good use case for some sort of to amplify, I guess is the right term for that. So I just need to think about like what's the best way to do that.
You want like a 3D map, 3D line chart.
I mean, so this is ultimately what it looks like. I mean, so, and that just shows me like these are the open positioning, or the open interest. I think this is just put side for on the S&P. So this is like put side positioning on the S&P below a certain strike. I think.
So where's like the data source?
I grab it. I'm grabbing it from Bloomberg, but like I would assume that any vendor would have the same data. So like, Icon would that for sure have the same data.
Ah, I see. Right. Yeah, I can work on that. I mean, I'm gonna like doing like some tech labbing anyway.
Yeah, I think I need to figure out two things. One is I need to figure out, do I need to keep a spreadsheet version, or can I fully appify it? Like, can I fully run it on an app, or do I still need to upload a CSV or some document that has all the data? Because ideally, like one of the problems that I have is, for the option, like every time I look through a company, I have to spend a lot of time to look at like what are the strikes. Like some strikes are normal, some are not normal, some are within it's a strike changes per dollar, some doesn't. So it's a little complicated, and what that means is I could miss strikes where there's a lot of volume. And so I have to go through this manual process. I don't want to go through the manual process. I'd ideally like something that like will just go and say get all of the strikes, right, and then plot all of the open interest on all of the strikes for all the next set periods that I want to analyze. So I need to see like if that's something that I could that I still need to have a CSV or spreadsheet for, or is that something that I could pull directly from Bloomberg, and then or Icon. Either way, would be interesting.
You'd need the data, but I'm sure you could do that in Python. That doesn't sound. Ifan, you're good at Python, right?
Yeah, I mean, I was like thinking about like doing something like a Wahdi portal, something like that, where we can all like view like different kind of like data analytics. I mean, it doesn't really like. I mean, it's just like how to like just like direct or like how to connect the data source to like an actual like presentation or like a dashboard or something like that. So yeah, I'll look into it. I mean, it doesn't really have to be real time, right? It's just like
yeah, even
daily.
any day. Yeah.
Daily is fine. Okay.
Right. Yeah. Absolutely.
Right. Yeah, I'll look into like Icon and see if like they have like a better way to kind of like export or yeah, I think export is or like actually stream the data somehow, depending on like their delay.
I can send you the spreadsheet, and you can send it to them, and they will actually give you the formulas to, or they'll iconify it, so they'll change everything to icon formulas. But I'm pretty sure, and yeah, you would be able to, this is not, it's not hard to replicate at all. In fact, the way that I do it is in a super clunky way. So,
Yeah.
where I actually, so I know the way that the Bloomberg lays out the way that they create the ticker for a call or for a put. And you're going to see I have like all these like embedded, equations to solve for that. But it's like, I think that I would rather just export all of the, get all of the strikes, right? And plot
Yeah.
that versus manually setting the strikes. That's like the biggest like issue that I've got. Like, because right now, it's like, for example, on the S&P, it's like I gotta set the strikes. That's been
Yeah, I mean, for S&P, it's just like there's too many strikes and too many expiries. Like we have 0 DTE now.
right.
And you really like the strike is kind of like, I mean, right now we're trading at like 55, 50 or like 56-ish. I mean, like the strike can go to like 1,000 or like 9,000. I mean, it's just like a
Yeah.
lot of strikes.
No, exactly. Yeah. So I just got to figure out a way to do it. So I will get back to you on this. I think it could be like definitely a fun project. I'm going to talk to Serge about it too, because I think he done something similar.
Yeah, I mean, yeah, for US equities, like I'll check like the icon first. Otherwise, I mean, there's like, I don't know. I don't know if like we need like another data source to be honest, but yeah, we'll check like the icon first. I'm watching like Tesla, like, yeah. There must be like a good way to kind of like export this. I'm gonna like delve into this anyway. I mean,
Yeah, definitely
just
take a look at icons like options, monitor tab, and see what they got in the analytics there. And so they have a bunch of training. I recommend that
right.
you like sign up for Aspen training as you want. And they'll, like, technically speaking, they will come to the office and also train you and give you a bunch of stuff. So their help desks they're there to help you. Um, you know,
Right.
so take full advantage. And then for the rest of you guys, I did get a secondary login with like the pared down version. And I'll share the login details in case anyone needs to get like market data and doesn't have access. Like I'll share that. So it'll be kind of like how it was in the past, where we had an icon login. I finally got that through. So we do now have an icon login that we can share. But I got Yefeng's. I got his with like all of the like bells and whistles. So it has all the additional functionality as well. And so that way he can replicate a lot of the work that I'm doing on like Bloomberg and analyze it. So should be kind of a good way for us to get really full coverage.
Nice.
Okay, guys,
think
I
I
actually
have,
gotta hop off. I got my dinner just arrived, so I'm gonna go eat. But I'll be around for the rest of the evening. So if you guys have questions or need something, feel free to ping me. I'll be working. So talk to you guys later. Great chat again. But
Great job. Yeah.
Yeah,
Talk
thanks,
to you
man.
later tomorrow. Yeah. See you all.
See you guys.